Hey, hi everyone. Okay, so today's topic will be trading the US dollar, right? Today is the 6th of January. This is our first webinar of the year. Happy to see you guys here. Happy you guys took the time to join the webinar. Um, Yeah, so let's get started. Today's the 6th of January. It is 5 o'clock here in Singapore. We start these webinars every time at 5 p.m. on a Tuesday. Okay, so I hope you guys are ready to learn. Okay, wait, sorry. Disclaimer before we learn anything. I do need to remind you guys that these webinars should only be construed as um, educational. It should not be construed as any form of investment advice, any form of financial advice, any form of signal to buy or sell. Anyways, I'm not going on a chart, so I cannot really give you a signal to buy or sell. But please don't take anything I say as a green light to go and buy something or sell something, okay? This is purely for educational purposes. Everything I share is based on my own experiences, my own research, my own point of view even. Okay, so risk warning, trading, Forex and CFDs, especially if you are trading on margin, carries significant risk and is not suitable for all investors, you may lose more than your initial investment. And I do urge you guys not to um, jump in the water before you learn to swim. Okay? I hope everyone is clear with the disclaimer. I do have to stay here for a minute or two so you guys can continue to read it. And then we will actually start the webinar in a bit. In the meantime, let me put, yeah, you guys read that. I'm gonna put some eye drops on. I just had eye surgery a few days ago, so I need to keep dropping eye drops every 20 minutes. Okay, cool. I am back. And you guys should be done with the disclaimer, I think. Maybe I'll stay here for another minute. Okay, cool. There should be enough time for you guys to read the disclaimer. I'm gonna move on to the next slide, which is the introduction to your host. That would be me. My name is Cassandra. You guys can call me Cass. I am an investment analyst at Rocket. We have been recognized as the finalist for the best Forex and equity research for multiple years running. Um, what we do here, a lot of forecasting, backtesting, a lot of understanding the markets, a lot of staring at the, not staring at the charts. We spend a lot of time on the charts to understand where certain pairs are going, how they behave, their characteristics, what's going to happen next. Okay, we study the markets a lot. And because I study the markets so much, I'm also a prop trader. For those who don't know what prop trading is, it means that I'm funded by multiple companies to trade their funds. How did I get this funding? I basically had to pass a test. Yeah, I had to pass a test, and that test requires me to do 10% profit within a month, and then I will get the funding. So I've done 10% profit within a month many times. How did I do it? Do that? I did a lot of technical analysis, and now I'm combining fundamental analysis that will make my setup a little bit more probable than before. Okay, so yeah, you guys are in good hands. If you guys have any questions, don't be shy. Ask me in the chat box. Especially today, we oddly have a bit lesser attendees than usual. Usually we have more than 1,000. Today we only have a few hundred of you. Okay, maybe the rest of you are still in the holiday mood, but yeah, happy to have the few hundred of you here today. Okay, I already see the chat box moving like crazy in the Vantage app, but for those who are on Zoom, feel free to ask me. Okay, our agenda for today is to understand why US dollar strength doesn't always mean risk off, how yields, reals, rates, and DXY really interact, and when the US dollar leads versus when it lags other assets. So US dollar, and then we're going to understand the US dollar scenarios, which is recession, soft landing, and reflation. So you guys already know how this works, especially the regulars here, Muhammad, Karsten, um, Nina, Helen, Joash, Bob, Lynn, you guys, Adam, I mean, Ellen, sorry. You guys are the regulars here. You guys already know how this works. We are going to do this entire webinar. I'm sure the rest of you are regulars too, right? Because there's 1,000 of you here every week. So I'm sure at least a few hundreds of you are regulars, but I'm more familiar with the people on Zoom because Zoom is a smaller group, whereas the Vantage app is just crazy. Okay, we are streaming on multiple platforms, by the way. Okay, you guys know how this works. We're gonna go through the agenda. We're gonna understand each topic a bit, and then at the end of the webinar, we should have about 10 minutes. And in that 10 minutes, we can use it to do a Q&A session. Okay? We're gonna do a Q&A session with the last 10 minutes. You guys have any questions, you don't have to wait until the end of the webinar. You can just ask me in the chat box. But if I don't think, if I cannot answer you quickly, I will wait until the end of the webinar and I'll let everyone ask their questions. And at the end of the webinar, I will give you my answers. Because sometimes you guys ask me questions where I actually need to like digest and think of the answers. I don't want to give you like the wrong answers either. Okay, so let's go. Okay, so why is the US dollar strength? Why does the US dollar strength not always mean that it is risk off? Okay, all right, let's start by breaking one of the most common mental shortcuts traders make, especially early on in their trading journey. You'll hear this everywhere, okay? I don't know if you guys have heard this. Let me know if you have. The US dollar is strong, so the markets are risk off. Have you guys heard this before? I know in general that's what it should mean, but that's actually not the case. Okay, I know it sounds clean, it sounds logical, okay, and it's very easy to remember, and because it's easy, traders repeat it without really questioning it. Okay, but in real markets, especially post 2010, okay, and even more after 2020, which is COVID, okay, that logic breaks down far more often than people realize. Historically, yes, the US dollar did behave like a safe haven currency. During periods of global stress, capital fled into US assets. Demand for global dollars surged, and risk assets like equities and emerging market currencies sold off. Okay, that relationship was strong during specific regimes. Okay, particularly when the US was seen as the cleanest, um, how do I put this? The cleanest dirty shirt in the room. Okay, but the markets have evolved. Okay, regimes have changed. If you trade today's market using a 2008 mental model, you will constantly feel confused. Okay, you will constantly be late, and sometimes you're going to be outright just wrong. Okay, so the first mistake traders make is assuming that the US dollar strength has only one cause. But in reality, right, the dollar can strengthen for completely different reasons. And each reason carries a totally different implications for risk assets. Okay? So it doesn't mean that US dollar is strong. It doesn't mean that it is risk off. Okay, sometimes it can also be risk on. Okay, sometimes the dollar is rising because investors are scared. Other times it's rising because the US growth is outperforming the rest of the world. And sometimes it's rising simply because US yields are more attractive than elsewhere, even if equities are doing just fine. Okay, so think about this from a capital flow perspective. Global money doesn't move based on emotions alone. It moves based on return, safety, liquidity, and opportunity costs. Okay, so if assets offer higher returns, better growth prospects or a more reliable policy direction, capital can flow into the US even during risk-on environments. Okay, that creates dollar strength without the panic, without the fear, and without broad risk liquidation. Okay, this is why you'll often see days or even months where the S&P 500 is rallying, yields are rising, and the dollar is also strengthening. But if you're stuck in the US dollar up equals risk off mindset, those periods feel impossible to trade. But if you understand the drivers, they actually make perfect sense. Okay, so the big takeaway here is that from from this slide, it's simple but crucial. Okay, it is simple. It's not hard to understand. US dollar strength is not a signal by itself. It is a symptom. Okay, if you will, it is a symptom. And before you trade it, you need to understand what's causing it. Otherwise, you're trading a label, not a market. Okay, so let's look at the different types of US dollar strength and what they really mean. Okay, so I put the US dollar, the S&P, and the DXY here. And let's kind of understand the different meanings. Okay, so now let's go one level deeper because this is where traders really start to separate themselves from the crowd. Not all US dollar strength is created equal. In fact, these are several distinct flavors of dollar strength, and each one tells a completely different macro story. The first type is what most people are familiar with, fear-driven dollar strength, right? I'm sure a lot of you, especially those who have been following me for weeks, know that, okay, US dollar is going up, maybe there is fear in the market, whatever, okay? This happens during a true risk-off events, okay? Financial crisis, sudden geopolitical shocks, systemic stress in the banking system. In those moments, investors don't care about returns. They care about survival. Okay, liquidity becomes king, and the US dollar, being the world's reserve currency, is the ultimate source of liquidity. In this environment, the US dollar rallies alongside falling equities, okay, widening credit spreads and collapsing risk appetite. Okay, this is the textbook scenario everyone learns first. But the second type is growth-driven dollar strength. Okay, and this is where many traders get trapped. This happens when the US economy is outperforming the rest of the world. Strong data, resilient consumption, higher productivity, better earnings outlooks. In this case, capital flows into US equities, US bonds, and US businesses. The dollar strengthens not because people are scared, but because they want exposure. Risk assets can rise at the same time and often do actually. Okay, then there's yield-driven dollar strength, okay, which has become extremely important in recent years. If the US interest rates and yields are meaningfully higher than those in Europe and Japan, global capital flows chase that yield. Okay, pension funds, institutions, and foreign sovereign investors rebalance into US fixed incomes. They need dollars to do that. So the dollar strengthens. This can happen even when volatility is low and markets are calm. And here's the key insight most retail traders miss. These drivers can overlap, cancel each other out, or dominate at different times. And that's why correlation between the US dollar and risk assets are not stable. They're regime dependent. Okay, so if you treat correlations as permanent laws instead of temporary behaviors, you will constantly misread the markets. Okay, so instead of asking, is the dollar strong or weak? The better question is, why is the dollar strong right now? Is it fear? Is it growth? Is it yield differentials? Or is it a combination of all three? That answer determines whether the US dollar strength is bearish, bullish, or a neutral for risk assets. Okay, so now let's look at how to read US dollar strength correctly as a trader. Let's bring this back to you as a trader, okay? Because understanding theory is useless unless it improves your execution, okay? And decision making. Execution is king. Execution is everything. Without execution, whatever, you can attend all the webinars you want. You can attend, watch all the videos, study as much as you want. The execution is the important part. Okay, so the goal here is not to predict the dollar. The goal is to correctly interpret what the dollar is telling you about the market environment. Whenever you see US dollar strength, the first thing you should do is pause and look at what's happening elsewhere. Are US yields rising or falling? Are equities rallying or selling off? What's happening to volatility? What's the broader macro narrative dominating the news cycle right now? These clues help you identify the dominant driver behind the move. If the dollar is rising while yields are rising and equities are stable or pushing higher, that is not a classic risk-off environment. That's usually a growth or yield story. In that environment, betting aggressively against risk assets simply because the dollar is strong can be a very costly mistake. On the other hand, okay, if the dollar is rising while yields are falling, equities are selling off and volatility is spiking. That's a very different signal. That's capital running towards safety. In that case, the US dollar strength reinforces risk of positioning rather than contradicting it. This is also why you should never, ever trade the US dollar in isolation. Never. I put this photo here to show you guys that you should be using multiple information, not just technical analysis. You should also be using fundamental analysis. You should also be using whatever data you can find, whatever news data you can find, combine it with your own analysis so that it makes your analysis higher probability. Okay. So a professional approach to trading the US dollar means um, treating it as a part of a macro ecosystem. The dollar sits at the center of global financial system. It interacts with rates, equities, commodities, and capital flows. When you ignore those relationships, you're essentially trading blind. Okay? Okay, so don't trade it as a standalone indicator. Strength or weakness only matters in context. Once you understand that, the confusion actually really disappears. Correlation starts to make sense again, and your trade becomes far more aligned with what the market is actually doing, not what headlines claim it should be doing. That's the mindset shift you need before we move deeper into how yields, real rates, and DXY truly interacts, which is where the real edge starts to form. Okay, so let's continue with our next subtopic, which is how yields, real rates, and DXY really interacts. Okay, let's start with nominal yields versus the dollar, the relationship most traders misread. Okay, now that we've cleared up the myth around the US dollar. Strength always means risk off. We need to talk about something that confuses even experienced traders. Okay, the relationship between the US yields and the dollar. Most traders are taught a very simple rule early on. Yields up, dollar up. Yields down, dollar down. And again, just like the risk of narrative, this works sometimes, but it breaks down far more often than people expect. Okay, let's start by defining what we mean by yields. When most traders look at yields, they are looking at nominal yields. Okay, sorry, give me a moment. I think I see the Vantage app turning black. Okay, I think we're good. Okay, everything's back to normal. Okay, sorry. I think the Vantage app stopped for a while, but I think it's okay now. Okay, so again, I think a lot of traders think that yield up meanings dollar up, yield down meaning dollar down. Okay, and again, just like the risk of narrative, this works sometimes, but it breaks down far more often than people expect. Okay, so let's start by defining what we mean by yields. When most traders look at yields, they're looking at nominal yields. That's the headline number you see on the US 2-year or the US 10-year Treasury. It tells you how much interest you earn, but it does not tell you how much purchasing power you gain. And that distinction is absolutely critical. Okay, nominal yields can rise for very different reasons. They can rise because growth expectations are improving, which is usually supportive for the dollar. But they can also rise because inflation expectations are rising faster than growth, okay, which can actually weaken the dollar. So from the outside, both scenarios look identical. Yields are up, but under the surface, the macro story is completely different. Okay, this is where many traders get trapped. They see yields pushing higher, they buy the dollar aggressively, and then they're confused when the dollar stalls or even sells off. Okay, the mistake isn't the observation. The mistake is assuming that nominal yields alone are what drives currency valuation. Currency don't just respond to yield levels. They respond to relative attractiveness. They respond to whether holding that currency preserves or erodes purchasing power over time. And that's why we need to go deeper than nominal yields and start talking about real yields, because that's where the real signals lives. Okay, so let's look at real yields, the true engine behind DXY. If you remember one thing from this entire section, let it be this, okay? The dollar does not care about yields. It cares about real yields, okay? It has to be the real yields. Real rates are simply nominal yields adjusted for inflation expectations. Okay. In other words, how much return you earn after inflation eats into your money. From a global investor's perspective, that is what actually matters. If you're choosing I see questions coming in already. Okay, I will answer your questions at the end of the webinar. Okay, because I see I will get to that actually in a bit. Okay. Yeah, so if you're choosing where to park capital, you don't ask where is the yield highest? You should be asking, where am I losing the least to inflation? Okay, where am I losing the least to inflation? Okay, or better yet, where am I gaining purchasing power? Okay, so when US real rates are rising, the dollar tends to strengthen. Why? Because holding dollars becomes more attractive relative to other currencies. You're being compensated more. In real terms, for holding the US dollar assets, capital flows in, demand for dollars increases, and DXY rises. Okay, now flip that around. If nominal yields are rising, but inflation expectations are rising even faster, real rates can actually fall. Okay, in that scenario, the headlines look bullish for the US dollar, but the underlying signal is bearish. Investors are earning more nominally, but losing more to inflation. That erodes confidence in the currency over time. This is why there have been periods where yields were screaming higher. Sorry, just checking. Okay. But the dollar struggled. Traders who only watched nominal yields were completely blindsided. Traders who watched real rates saw it coming. Okay, so another important point here is the time horizon. Um, Real rates tend to matter more for medium to long-term US dollar, okay, trends, while nominal yields can drive short-term volatility. If you're day trading, both matters. If you're swing trading or positioning over weeks to months, real rates dominate. Understanding this relationship is a huge step towards US dollar, like a macro professional rather than reacting to surface level data. Okay, so putting it all together, the yields, the real rates, and the dollar regime. Now let's zoom out and connect all the pieces, okay? Because this is where everything starts to click, okay? Again, I think we all know that the dollar doesn't move randomly. I always tell you guys, the markets doesn't move randomly. Okay, it moves in regimes. Okay, and those regimes are heavily influenced by interaction between growth, inflation, nominal yields, and real rates. In a strong growth, controlled inflation environment, nominal yields rise, real rates rise, and the dollar strengthens. This is very US dollar positive regime. Capital flows towards the US. Risk assets can still perform, and the dollar trends higher in an orderly way. In an overheating economy where inflation is running ahead of growth, nominal yields may rise sharply, but real rates stay flat or fall. This is where the dollar can struggle and become volatile. You'll often see choppy DXY price action, failed breakouts, and confusing correlations across the market. Then you have the disinflationary and recessionary environment. Nominal yields fall, but if inflation collapses faster, real rates can actually rise. Okay, in those cases, the dollar can strengthen even as growth deteriorates. This is where traders get completely lost if they're not watching real rates. So as a trader, your edge is not predicting the next CPI print or the next Fed meeting. Your edge is correctly identifying the regime you're in and aligning your US dollar trades with that regime. Once you understand whether real rates are rising or falling and why, okay, DXY movement stops feeling random and they start feeling logical. This framework is what allows you to trade the US dollar with confidence, with clarity, instead of reacting emotionally to every data release. And with that foundation in place, you're ready to move on to one of the most important practical question when the US dollar actually leads market and when it lags behind them. Okay, so let's move on to our next subtopic, which is when does the US dollar lead versus when it lags other assets? Okay. Okay, let's all have a water break. Been talking a lot today. Okay, so let's move on. Okay, so we're gonna start with the US dollar as a leading indicator. When Forex moves first, one of the most powerful skills you can develop as a macro trader is knowing which market moves first. Traders often assume equities lead everything simply because that's where most attention is. But in reality, okay, foreign exchange and especially the US dollar often moves before other asset classes. Okay, so when that happens, the US dollar becomes a leading indicator rather than a reaction. Okay, the reason for this is, I would say, structural. Okay. Um, Forex, okay, why? Because I mean, Forex is the deepest, most liquid market in the world. It trades 24 hours a day. It reacts instantly to policy shifts, and it reflects cross-border capital flows in real time. When large institutions start repositioning for future macro changes, they often do it first through currencies. It's faster, it's cheaper, and more flexible than moving size through equities and bonds. So you often see this around major policy transitions. For example, when the market starts to anticipate tighter monetary policy in the US, the dollar may begin strengthening weeks or even months before yields fully reprice and equities react. Forex traders price expectations, not outcomes. That makes US dollar a forward-looking signal in certain regimes. Okay, so another situation where the US dollar leads is during early risk aversion. Before equities sell off sharply, you may see US dollar strength against higher beta currencies. Okay, funding currencies being unwound and emerging market forex start to crack. These are subtle shifts and they're easy to miss if you're only watching stock indices. Okay, the key is that the US dollar leading behaviors tend to appear when expectations are changing, not when news is hitting the headlines. So if you wait for confirmation from other markets, you're often late. Okay. Learning to spot early US dollar strength or weakness allows you to position head or broader moves rather than chasing them. Okay, so when the US dollar lags, following rates, equities, and commodities, okay, um, now just as important as the US dollar leads is knowing when it doesn't. Okay, there are many periods where the dollar is not the driver, but the follower. In these environments, trying to force the US dollar leadership will lead to frustration and overtrading. US dollar tends to lag when markets are in a stable, well understood regime. For example, during long equity bull markets with predictable monetary policy, the dollar often responds to what equities and rates are doing rather than dictating the direction. So risk appetite drives flows and Forex adjusts afterwards. So another classic lagging environment is commodity-driven cycles. The global growth accelerates and commodities rally. Currencies tied to those commodities move first. The dollar reacts to a counterbalance rather than a catalyst. Okay. In those moments, watching the US dollar for leadership gives you honestly very, very little edge. Okay, it's not going to help much. This is also where correlation becomes very strong. You'll see clean inverse relationship between the US dollar and risk assets, or even tight linkages between the US dollar and yield differentials. Okay, these are the periods traders love because price actions feels orderly and predictable. But ironically, these are also the periods where the US dollar provides less new information. So understanding the US dollar is lagging allows you to shift your focus. Instead of trying to predict the dollar, you trade it as confirmation. Okay, you wait for rates, equities, or commodities to move, and then you use the US dollar to express that view in Forex pairs. This patience is critical. Many traders lose money not because they're wrong on direction, but because they're early in lagging regime. So, I mean, honestly, I'm not even talking about like US dollar and thing. I'm just talking like in general. Timing matters. Okay, no matter what you're trading, timing matters. And knowing who leads helps you time better. Okay? Okay, so let's look at a practical framework and how to identify leadership in real time. So how do you actually identify whether the US dollar is leading or lagging in real time? This is where structure and observation come together. You don't need complex models or proprietary indicators. You need consistency in what you watch and and like how you interpret it. Okay. Start by asking simple question each week. What is the market currently trading? Is it trading growth, inflation, policy, or fear? The answer tells you which asset class is likely to lead. Policy-driven environments often see Forex move first. Growth-driven environments often see equities and commodities take the lead. Okay, so next, what you want to do is observe sequencing. Okay, when data comes out, okay, which market reacts first? Um, does the US dollar move before yields? Or do yields spike and the US dollar follows? Okay, over time, patterns emerge. You will start to recognize these patterns. If you follow the markets close enough, you will start to see patterns. There guys before that because I studied the gold so much, XAU USD, I started to see patterns. I started to see wicking. I started to see things repeating over and over. Okay, so if you follow it close enough, you will start to see patterns. Leadership is not random. It repeats within regimes. Okay. Also, pay attention to failed moves. If the US dollar breaks out, but other assets don't follow, I would say that's a warning sign. Either the US dollar is sending an early signal, okay, or it is a false move that will fade. Okay, context decides which one it is. Okay, context always matters. I tell you guys this all the time. Context always matters. Okay. Okay, the goal here is not perfection. The goal is alignment. Okay. When the US dollar is leading, you trade it proactively. When it's lagging, you trade it reactively. Okay, that single adjustment can dramatically improve trade selection, reduce frustration, and help you stay in sync with the dominant macro flow. With the framework in place, we're ready to move into the final and most scenario-driven section, which is how US dollar behaves under different macro outcomes like recession, soft landing, and reflation. So the US dollar scenarios, recession, soft landing, and reflation. Let's go into our last part and then we can do our Q&A session. I see questions coming in already. There's one, two questions so far on Zoom. Let me check Vantage app. Vantage app, I'm sorry. I'm trying to scroll up. I'm trying to scroll up. If you ask me a question, Vantage, I'm trying to scroll up, but the new message will just bring me back to the bottom of the chat. So if you have a question, just keep spamming it, and I will see it eventually at the bottom. Okay. So I'm taking a lot of water breaks. I did mention just had eye surgery a while ago, like actually just a few days ago. So I need to make sure my eyes are lubricated. I need to make sure I'm hydrated because dry ice is real. Okay, let's go into our last section and then we'll do our Q&A. Okay, USD in recession scenarios, liquidity, safety, and panic flows. Okay, let's finish up this session by tying everything together in real world scenarios because this is how professional macro traders actually think. They don't trade isolated indicators. They trade narratives and outcomes. And when it comes to the US dollars, the three big macro scenarios, you need to understand recession, soft landing, and reflation. So we'll start with recession. Okay. Yeah. Because this is the scenario most traders instinctively associate with dollar strength, and for good reason. In a true recession, the dominant force in markets is not growth, it's not yield, it's actually liquidity. Okay, so when economic activity contracts and financial stress rises, investors stop caring about return and start caring about as access to cash. Okay, so in these environments, the US dollar tends to strengthen because it is the global funding currency. Corporations, banks, and governments all over the world have USD denominated liabilities. Okay. When stress hits, they need dollars to service debt, roll funding, and meet margin calls. That creates an urgent, non-negotiable demand for the US dollar. This is why during deep recessions or financial crisis, you often see the dollar rally even if the US economy itself is suffering. The move is not about the US strength, it's about the global independence on the US liquidity. This distinction is critical because it explains why the dollar can rise even when the US data is terrible. Okay, so for traders, this environment tends to be very directional, but also very emotional. Volatility is high, correlations snap back to old school risk of behavior, and patience become essential. Chasing late moves can be dangerous, but being positioned early can be extremely rewarding. Understanding this scenario helps you avoid fighting the dollar during periods where its strength is structural and not technical. Okay, so we're going to move on to the second one, which is the US dollar in soft landing scenarios. range bound and selective and nuanced. Okay. Okay, two more slides and then I'll start answering your questions. I do see your questions coming in. Thanks for asking, by the way. I do love it when we make these webinars very interactive. That way it's not so boring for me either. It's not so dry for me either. It's not so dry for you guys either. So I like that you guys have questions coming in. But let me just finish these last two slides and then we will actually do the Q&A. Okay, so now let's talk about the scenario markets love to debate endlessly, which is the soft landing. This is the environment where growth slows but doesn't collapse. Inflation cools without crashing demand, and central bank manage to normalize policy without triggering a recession. Okay? In this scenario, the dollar behaves very, very differently. You don't usually get explosive trends. Instead, you get range-bound, selective, and sometimes frustrating price action. The US dollar strength and weakness alternate depending on data surprises, policy expectations, and relative performance versus other economies. Why does this happen? Okay, because in a soft landing, there is no dominant force. Liquidity stress is low, growth differentials are moderate, and real rates tend to stabilize. Without a strong macro driver, the dollar loses its role as a clear signals and becomes more of a tactical trading instrument. This is where relative value matters most. Okay. Traders focus on which economies are handling the slowdown better, which central banks are closer to easing, while and where real rates differentials are shifting at the margin. Okay, US dollar trades become more pair specific rather than broadly directional. Okay, so for many traders, this is the hardest environment to trade. There's no clear villain, no obvious hero, and no clean narrative. But for disciplined traders, it's also where consistency is built. You stop looking for big macro calls and start focusing on execution, structure, and timing. Understanding that a soft landing procedure chop rather than trends help you adjust expectations and avoid forcing trades that the market simply isn't offering. Okay, so let's go into our very last slide for today, and then we will have our last part, which is the Q&A. I already see 4 questions so far. If you guys have more, ask me in the chat box. Vantage chat, don't see any questions, mostly because the chat is moving like crazy. Like, yeah, let's go. Okay, so last part, which is the US dollar in reflation scenarios, growth, risk appetite, and dollar weakness. Okay, so finally, let's look at the reflation scenario because this is where the dollar often struggles the most. Reflation occurs when growth reaccelerates and inflation expectations rise, usually after a slowdown or policy easing cycle. In this environment, risk appetite returns and capital starts flowing out of defensive assets into growth-sensitive ones. For the dollar, this can be challenging. As global growth improves, investors look for higher beta opportunities outside the US, okay? Outside of the United States, okay? So capital flows into, where do you guys think it will flow to? If it's not flowing to the US, where do you guys think it's flowing to? Seeing if you guys are still following me. Okay, thank you very much, Muhammad. Yes, capital will flow into emerging markets. Emerging market is one, but it also flows into commodities and cyclical currencies. Okay, so at the same time, inflation expectations can rise faster than nominal yields, keeping real rates under pressure. This combination tends to weaken US dollar over time, not because the US is doing poorly, but because the rest of the world is catching up or off, or even outperforming. The dollar loses its relative appeal and diversification becomes attractive again. Okay, so this is the environment where you often see strong trends in commodities, emerging markets, like I said, and carry trades. The US dollar becomes the funding currency rather than the destination. For traders, this is where understanding regime shifts pays off the most. Okay, fighting US dollar weakness in a reflationary environment can be costly and emotionally draining. The key lesson across three scenarios is this: the dollar does not have one permanent behavior. Its role changes depending on the macro backdrop. If you can correctly identify which scenario the market is leaning towards, you stop reacting to noise and start positioning with intent. Okay? So, and that will ultimately separate reactive traders from strategic ones. Okay, so we are done with today's webinar. Thanks everyone for joining. So before we move on to the Q&A, do follow Vantage on whatever social media handles. This is their social media handles. Follow them on social media. You can follow them on Facebook, vantagemarkets.global, Instagram, Vantage Markets, X, this is not Twitter anymore, okay, Vantage MKTS, and LinkedIn, Vantage Markets, and of course, Telegram to get the latest news and updates from Vantage. Okay, so let me pull out your questions. Okay, hi. Okay, so if the USD is going up together with stock, should we still treat that as a bullish signal for the dollar, or is that a warning sign? Okay, if the US dollar is going up with stocks, should we still treat that as a bullish signal for the dollar, or is that a warning sign? Okay, that's a very good question. Okay. And that's one of those moments where context, okay, context matters more than the move itself. Okay. How do I put this? Okay. If the US dollar and stocks are rising together, it's not automatically a warning sign. Okay. Most of the time, that tells me that the move is being driven by growth expectations, or maybe even yield differentials, okay? But definitely for me, okay, for me, it's definitely not fear. I'll then check real rates. If the real rates are rising, that US dollar strength is usually valid and can persist. If real rates aren't confirming it, then I start treating the US dollar move more cautiously and expect it to fade rather than trend, okay? So I hope that answers your question. I see 4 questions here, 5 questions actually. Let me try to answer all of it. Okay, which yield should we watch more for USD trading, the 2-year or the 10-year? Okay, thank you for asking that. If I had to prioritize, honestly, I'd say the 2-year tells you more about policy expectations, while the 10 years tells you more about growth and inflation expectations. Okay, so for shorter term USD moves, okay, if you are looking at short term, we're talking about especially around central bank expectations, the 2-year will be more relevant. Okay, for bigger, we're talking about like swing trading, like multi-week, multi-month USD trends. The 10-year and real yields matter more, obviously. Okay, the longer, then you look at the bigger one. Okay, so ideally you watch both and see which one the market is reacting to. Okay. Next question. Why does the dollar sometimes fall even when US data comes out short? Okay, context is important. So that usually happens when strong data already expected or already priced in. Okay, I think I mentioned this in previous webinars. The markets are already, usually a lot of times are already priced in. Okay, or even when inflation expectations rise alongside the data. If growth data is strong, but the inflation is also accelerating, real rates may not improve. In that case, the data looks good on the surface, but it does not actually make holding the US dollar more attractive. Okay, markets trade surprises and relative changes, not absolute numbers. So a lot of times when news are already out, it was already priced in and there was not going to be a reaction anyways. Okay, let me see what's the next question here. How can we realistically track real rates without complex tools? Okay, how can we can how can okay, so when you say we, I'm assuming like you and I, retail traders, right? How do we track real rates without complex tools? Without the tools. Okay, honestly, you don't need anything fancy to track real rates. A simple way is to watch the US 10-year yield alongside US inflation expectations, okay, like break evens, okay? Even if you don't calculate real rates perfectly, you can still see directionally whether reals are rising faster or slower than inflation expectations. So over time, you start to notice how closely the USD trends line up with that relationship. Okay, so you really don't need any like complex tools or anything fancy. Just follow 10-year yields and the inflation expectations. Okay. Okay, so let me move on to the next question. I think this is the last question. I don't see any more questions. If you guys have questions, please ask me in the chat box now. Otherwise, after this question, I will end the webinar because I don't really see any more questions coming in. If you do, just ask me right now. Don't be shy. Okay, is the US dollar, sorry, is DXY enough or is DXY enough? Okay, that's a very good question. Okay, I'm assuming if you're asking if the US DXY is enough information, okay, or I mean, you should look at other individual pairs. Okay, so DXY is great for understanding broad dollar direction, okay, but trades are executed in pairs, okay, not in the okay, if that makes sense. Sometimes DXY is flat because strength in one pair is canceling weakness in another. That's why I like using the DXY for buyers and individual pairs for execution. Okay, I think, okay, you can use DXY as a compass, but not your entry stick. It's a compass, okay? It's there to kind of give you a rough idea, but that's about it, okay? Okay, guys, I think that's it. I don't see any more question. Thanks everyone for joining. Thanks, Nina. Thanks. Okay, I will catch you guys next week. Happy New Year 2026. I hope this is a fruitful year for you. I hope it's a fruitful year for everyone, honestly. Okay, positivity, positivity. That's all we want. Okay, so I will catch you guys next week. Take care, everyone. Same time next week. Thank you, Kirsten. Thank you, Mama, Joash, Bob. Thanks for joining. Thanks for taking the time to thank Sean for stepping into our webinar. I will see you guys in a week, same time next week, 5 p.m. Singapore time, every Tuesday. Next week will be another interesting topic. Okay, thanks, guys. Take care. See you guys soon.